Think about the financial tools you use every day. Your bank account, your credit card, the way a business tracks its profit and loss, the fact that a company in New York can owe money to a supplier in Tokyo without anyone physically moving gold across an ocean. These ideas feel ancient, obvious, baked into the basic logic of how the world works. And in a way, they are ancient. They trace back, in a remarkably direct line, to a single-family bank that opened its doors in Florence in 1397. The Medici didn't stumble into history. They built it one ledger entry at a time. In 1397, a man named Giovanni di Bicci de' Medici founded his bank in Florence with an initial capital of roughly 10,000 gold florins. To put that in context, it was a meaningful but not extraordinary sum. Enough to establish credibility, not enough to make you the most powerful financial institution in Europe. Not yet. What Giovanni had wasn't a vault full of gold. It was a set of ideas about how banking could work differently. And over the next century, those ideas would reshape the financial architecture of the Western world. Bear in mind that surviving records from this period are fragmentary, and many of the specific figures historians work with are approximations pieced together from later correspondence and secondary sources. But the broad picture is clear enough. Giovanni was building something new. The first thing he needed was a way to actually see what was happening inside his bank. And this is where double-entry bookkeeping becomes essential to the story. The Medici didn't invent double-entry bookkeeping from scratch. The method had earlier roots in Italian merchant culture, but they perfected it, systematized it, and made it the operational backbone of a multi-branch institution. Here's the core idea. Every single transaction is recorded twice. Once as a debit, once as a credit. Assets always equal liabilities plus equity. The books must balance. Always. No exceptions. That sounds dry. It is not. Before this system, running a large business was essentially an exercise in educated guesswork. You had rough tallies, informal records, a general sense of whether things were going well or badly. But you couldn't precisely track profit and loss across multiple locations. You couldn't catch a dishonest branch manager cooking the books in Venice while you were sitting in Florence. You couldn't make rational capital allocation decisions based on actual data. Double-entry bookkeeping changed all of that. It gave the Medici clarity, control, and scalability. It meant the bank could grow, open new branches, take on new partners, serve new clients without losing its grip on what was happening financially. Every spreadsheet in every corporate office in the world today is a direct descendant of the system. The second innovation was arguably even more radical. Letters of credit and bills of exchange, the instruments that allowed money to move across borders without actually moving at all. We touched on the basic mechanics earlier. A merchant deposits gold in Florence, receives a written instrument, and a partner branch in London honors that instrument in local currency. The two branches settle up between themselves. The merchant's money traveled safely. No gold convoy through mountain passes. No bandits. No catastrophic loss. But there's a layer to the story that goes beyond convenience. The church had declared usury, lending money at interest, a mortal sin. And yet trade was booming, capital was needed, and nobody was going to provide it for free. The bill of exchange was the elegant solution. The Medici made their money on the exchange rate difference between the two currencies involved in the transaction. Technically, this wasn't interest. It was a currency conversion fee. The church couldn't easily condemn it. The merchant didn't care what you called it. And the Medici quietly captured the spread. Regulatory arbitrage. Avant la lettre. Centuries before anyone had a name for it. Now, for these instruments to work, you needed something that no single office could provide: reach. And this is where Giovanni's third foundational move comes in. He built a network. Not a loose collection of affiliated traders who happened to know each other. An actual coordinated system of Medici-controlled branches in Rome, Venice, Milan, Bruges, London, Geneva, Avignon, Lyon, and more. Each city was a node. Each branch could issue and honor instruments from the others. Together, they formed something that looks, in retrospect, remarkably like an early multinational banking system. But here's what made the network truly durable: the way Giovanni structured each branch. Every office was set up as a legally independent partnership. The Medici family held a majority stake, but the local branch manager, the man on the ground, was required to invest his own capital. It's skin in the game. If the Venice branch made bad loans, the Venice manager felt it personally. This aligned incentives in a way that pure employment never could. The manager wasn't just following orders from Florence. He was protecting his own money, and the Medici, for their part, retained majority control and the final say on major decisions. Each branch could theoretically fail without bringing down the entire institution. Risk was distributed. Liability was contained. This is, in its essential structure, the model of every modern holding company, every venture capital fund, every corporate subsidiary arrangement. The Medici built it in the 15th century because they needed to survive. And then came the move that transformed the bank from powerful to something approaching indispensable. The Medici became the principal bankers to the papacy. Think about what that meant in practice. The Catholic Church was the largest and most geographically dispersed financial institution in Europe. It collected revenues, tithes, fees, taxes, from parishes and kingdoms across the entire continent. It needed someone to manage those flows, to hold the deposits, to move the money. The Medici volunteered. By 1427, records suggest the Rome branch alone held papal deposits of around 100,000 florins, and it's worth noting that historical estimates here vary, so treat that figure as an approximation rather than a precise accounting. What's undeniable is the scale and significance of the relationship. The Rome branch consistently generated the largest share of the bank's total profits, and under Cosimo's leadership from around 1435, it became the engine that powered everything else. The irony was delicious. The institution that had condemned usury as a mortal sin was now entirely dependent on a Florentine banking family to function. The Medici were, as contemporaries sometimes called them, God's bankers, and with that designation came something beyond profit. It came prestige. It came access. It came the kind of credibility that opened doors in every court and counting house in Europe. What Giovanni de' Medici had built by the time he passed leadership to his son Cosimo wasn't just a bank. It was an infrastructure, a system of trust, instruments, accounting, and relationships that allowed capital to flow across Europe with a speed and safety that had never existed before. The tools were new. The network was new. The organizational logic was new. And the consequences of all of it are still with us today, embedded so deeply into how finance works that we've stopped noticing they had to be invented at all. So the infrastructure was in place. The network was humming. The accounting was tight. The papal relationship was locked in. And for a period of roughly 2 decades under Cosimo de' Medici's leadership, the bank didn't just work. It dominated. To understand the peak, you have to understand just how lopsided the profit picture was. The Rome branch wasn't merely the largest operation in the network. It was, by historical estimates, generating something close to 60% of the entire bank's total profits at its height. 60% from a single office. The reason was the papal account, the sheer volume of church revenues flowing through Medici hands, from tithes collected in England to fees paid in France, all of it funneled through Florence, all of it earning the bank its spread on every currency conversion along the way. Contemporaries called the Medici God's bankers, and the nickname wasn't purely affectionate. It captured something real about the power dynamic. The Pope needed the Medici more than the Medici needed any single pope. And the profit model, remember, was built on an elegant fiction. The bank never called what it earned interest. Every transaction was framed as a currency exchange. A merchant or client deposited money in one city and withdrew equivalent value in another at a rate the Medici set. The difference between the rates, the spread, was pure profit. The church got its absolution. The Medici got their margin. Technically, no usury occurred. In practice, the Medici were running one of the most sophisticated interest rate businesses the medieval world had ever seen. Dressed up in the language of commerce. Regulatory arbitrage, executed flawlessly for generations. That financial success fed directly into political power, and the political power fed back into the financial success. Cosimo de' Medici didn't govern Florence the way a king governed a kingdom. He governed it the way a creditor governs a debtor. If your family had borrowed from the Medici, and most of Florence's important families had, at one point or another, you were disinclined to vote against them, speak against them, or organize against them. The bank's ledger was effectively a map of political obligation, and the same logic extended outward across Europe. Cardinals, dukes, and merchants who depended on Medici credit were, in a quiet and completely deniable way, Medici clients in the broadest possible sense. The bank wasn't just a financial institution. It was a soft power apparatus, one that operated through obligation rather than force. For a time, this was genius. and then it became a trap. The problem with building your empire on credit is that credit depends on repayment, and the most powerful clients, kings, princes, sovereigns with armies, are precisely the clients most capable of simply deciding not to repay. There's not much a Florentine banking family can do when the King of England looks at his debt and shrugs. This is exactly what happened. The London branch of the Medici Bank extended significant loans to Edward IV of England. Edward was fighting wars, consolidating power, and perpetually short of cash. A reliable customer in the short term and a catastrophic one in the long term. The loans grew. The repayments didn't keep pace. The Bruges branch, meanwhile, had extended credit to Charles the Bold of Burgundy, one of the most aggressive and financially reckless rulers in Europe. Charles spent lavishly, fought constantly, and had very little interest in treating a banking family's ledger as a binding moral obligation. These were not ordinary commercial loans to merchants with collateral and clear incentive to maintain their credit rating. These were sovereign debts, and sovereign debtors in the 15th century operated by different rules. The losses, while difficult to quantify precisely given the fragmentary records that survive, were severe enough to damage branches that had once been among the network's most productive. And here is where the story turns from bad luck into structural failure. Because the losses from Edward and Charles might have been survivable, expensive, damaging, but survivable if the bank's governance had held, it didn't. Under Lorenzo de' Medici, Lorenzo the Magnificent, patron of Botticelli and Michelangelo, the man who turned Florence into the cultural capital of the world, the bank quietly frayed. Lorenzo was a brilliant politician and an extraordinary patron of the arts. He was not, by most historical accounts, a rigorous banker. The close oversight that Cosimo had exercised over branch managers, the discipline of the partnership model, the careful monitoring that double-entry bookkeeping was supposed to enable, all of it degraded under Lorenzo's more distracted leadership. Branch managers operated with increasing independence. Decisions that should have been referred to Florence were made locally. The incentive alignment that had made the partnership structure work, managers investing their own capital, personally exposed to bad outcomes, was diluted, as some managers accumulated power without proportional accountability. The bank's fundamental weakness was now fully exposed. Concentration risk. The Rome branch had always generated a disproportionate share of the profits, which meant it also represented a disproportionate share of the vulnerability. When papal relationships soured, as they periodically did in the volatile politics of the Italian peninsula, the entire institution felt it. Add the sovereign loan losses in England and Burgundy, add the governance drift under Lorenzo, and the bank that had once looked impregnable began to look fragile. The final blow came not from finance but from politics, which is fitting because the bank had always been as much a political institution as a financial one. In 1494, the French army of Charles VIII swept into Italy. The Italian wars had begun. The Medici's hold on Florence collapsed. Lorenzo had died in 1492, and his son Piero, remembered by Florentines as the Unfortunate, made a series of catastrophic diplomatic miscalculations and was driven from the city. Without Medici political control of Florence, the network that had taken nearly a century to build lost its center of gravity almost immediately. Branches that had already been weakened by bad loans and loose governance had nothing left to anchor them. They were liquidated, one by one. The Rome branch, the London branch, the Bruges branch. By the end of 1494, the Medici Bank as a functioning institution had ceased to exist. But here's the thing about an idea that works. You can't unlive it. You can't close a branch on a concept. The bill of exchange didn't disappear when the Medici did. Double-entry bookkeeping didn't disappear. The holding company structure didn't disappear. Other banking families, in Augsburg and Antwerp, eventually in Amsterdam and London, picked up the tools the Medici had refined and built further on them. The collapse of the bank was, in retrospect, almost beside the point. What mattered was the century of innovation that preceded it. The Medici story is ultimately a lesson in how power and vulnerability are built from the same material. Concentration, of papal profits, of sovereign clients, of political influence in one family in one city, was what made the bank great, and what made it breakable. Every financial institution that has come since has, in one way or another, grappled with the same tension. The returns that come from concentration versus the resilience that comes from diversification. The Medici learned it the hard way. So, periodically, does everyone else. If this kind of deep dive into the hidden history of finance is what you're here for, hit subscribe. there's a lot more where this came from.